Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Good evening, friends, to all that have joined into this broadcast this Friday evening. My guest this week is Mr. Kenneth Andrade, a man who needs little, if not any, introduction. One of the most distinguished fund managers in India, has had a spectacular track record behind him, and is seen as probably one of the best stock pickers of my generation, at least since I entered the capital markets. He's the founder and CIO of Oldbridge Capital Management. It's something that he's been doing for the last 4 or 5 years. Prior to that, he was the head of investments and the CIO of Idfc Mutual Fund, which was, of course, started off as Standard Chartered Mutual Fund and then subsequently taken over by Idfc. He's had a brief stint with Kotak Mahindra AMC as well for about 3 years, and he's been on the sell side, on my side of the table for a few years before that with Sher Khan and LKP Securities as well. So a very long and a very distinguished career, and he's been on both sides of the table, sell side as well as buy side. Kenneth, good evening. Thank you so much for taking time out to do this. We get a status check from you that everything is fine in your office, family, friends, all are doing well in these times.
Thank you very much, Rahul, for inviting the session. Yes, and everything's perfectly fine at our end. Everyone's safe and everyone's comfortable.
Awesome. So let's get kick-started then, Kenneth. Let's talk a little bit about your journey. And, I've been doing a lot of reading thanks to the research that my colleague has dug up on you and your past. And, obviously, the assets under management when you were at IDFC actually did pretty well. I mean, you took it all the way up to $9 billion. And, you've had a spectacular track record. I think, if I'm not mistaken, almost 90% of the time you've beaten the underlying benchmark, if that is a correct statistic that I had. Tell me a little bit about how you went about doing it, and sort of tie it into what Vetri Subramaniam has publicly said about you, that you tend to keep things very simple and basic, and you are yet a very big contrarian at heart, and yet you manage a spectacular track record. So just basically your thought process, your approach to investing. When you say simple, how simple do you keep it?
Well, my journey in investing actually started out by me not even looking at the benchmark and not even wanting to beat the benchmark. It so incidentally happened that you got businesses that did what they were supposed to do, and they got to a size, scale, and direction that was much larger than what anything that was underlying in their industries. And that's how simple you can keep it. I mean, I find a lot of investors trying to beat benchmark or compare themselves with something that's not in there. And I think that's how I went. It's not a science. It's not an art. It's not a science. It's just pure common sense. You have to buy efficient capital at mouth-watering prices. And once you've been able to identify with that structure, I mean, things fairly simplistically come up with. And then try not to make too many mistakes. And but at all points in time and in every cycle that you have, you will make mistakes. But you have to keep them to the minimum. So for most investors, as you age, I think your strike rates go higher because you just learn by experiences as not to do the same mistake again and again. So I think that's in short what's got us here.
It's been very interesting to read up, Kenneth. If I'm not mistaken, the IDFC Premier, of course, all three, Premier, Sterling, and Opportunities have had a good run. And if I'm not mistaken, Premier was about $30 million when it started, and currently is about $1 billion. So that's quite a spectacular run and a legacy you left behind at IDFC even as you moved on. But I was just reading somewhere that on the Premier side, most of your investors, I think 70 stayed over 5 years, which is a little unusual. So that's obviously a very big bet that they took on the person that was running the fund. And another very interesting thing that I read about was that during a 5 or 6 year period, you opened up the fund only about 3 or 4 times to take in inflows, and that was the time when you were most convinced that this was the time to invest. So, talk to me about both of these aspects and how they came to be.
So that decade of mine as a public manager of mutual fund, I think there were a number of us, and thanks to the regulatory framework and thanks to the management also of the firm, and I had a great team with me. We did a number of firsts, I mean, a spectacular number of firsts, and all of that because we were the youngest equity mutual fund on the ground. So the fund in question, which was Idfc Premier, was probably one of the few funds globally which was open for redemptions and closed for subscriptions. Okay, and yet we never lost money. We grew every year. In sterling, we started off as a close-ended fund, and in 18 months, we requested the regulator to make it an open-ended fund, which they obviously accepted, and that was another story that we went out to tell. The third was the opportunities. This was in a period of time where there was no approvals for close-ended products that were for any equity products that were there, and we just went into the regulator citing an opportunity that was there in the market, and this was in late 2012, and it was simply mouth-watering valuations in the small cap side, and we didn't have a small cap portfolio. We went in with a close-ended fund, and then the rest was history. After we launched that fund, I think the industry launched another 50 or 60 funds post that, all in close-ended nature. So those are a couple of things that we did at that point in time. But yes, it was a fairly exciting period. Investing was also fairly simple at that point in time. All you had to do was buy stock and sit, and 10 years you just multiplied your money that before that period I never thought was possible. Okay, and it so happened that we went that cycle. So it was a different period of time, and yes, those 10 years were extremely rewarding. Not to say that my 3 years spent at Kotak wasn't very different. I think we collected, when I joined Kotak, we were managing equity values of about 150 or 200. My first experience portfolio management, I joined them as an analyst. So there are two levels of journey that I've transitioned in terms of the career. And yes, Premier did extremely well. So did Sterling, and so did Equity Opportunities. We also did a couple of PMS, and it was what you always wanted to do. You wanted to manage money with huge amount of alpha, and it all came through in that decade.
It's not every day that you are able to marry quality with valuations. And if I take you back to your Kotak days, if I'm not mistaken, you started looking at GSK Consumer at about 11, 12 times. You started looking at a Bata at sub 15 times. Obviously, the world has changed since then, and you don't see quality at that price. How do you approach? I mean, so on one hand, you say be contrarian. One of the ways to be contrarian is to probably try and find value where the rest of the market is not. And the other is, of course, you want to play cash flows, you want to play earnings growth, but the market probably has overpriced them already. How do you sort this dichotomy in your mind when you are positioning yourself as an investor?
So every business and every industry, there's an element of quality to it, and it depends upon where in the cycle you are. So in year 1999-2000, technology, the big companies, there was enormous amount of quality in those businesses because they were getting market share, they were you're producing results. They were growing very rapidly. Okay, and that's where the market got hooked on, and the quality cycle was prevailing even at that point in time. Then you had was there with the commodity and the domestic market. And if you go back to 2004 and 2005, and that was one of those 2 years where even a Tata Steel did a 45% return on equity. And that was a commodity business. Now, to achieve something like that, it takes something when it got completely, the business got completely realigned to historical, to the way it historically, I wouldn't say managed, but the slowdowns historically, and all of that showed up in product prices, and that was quality at that point in time. But I didn't do anything radically different from what most investors should be doing. Okay, you just arbitrage cash flows, good quality businesses, okay, at the low of their cycle. So why was Bata at 15 times earning, and why did Bata actually pop up on my screen? That story was a little different. You go back into the 90s, it was a debt laden. It was sitting out of Calcutta. Okay, it had a union problem. They were running almost 250 crores of labor costs on their book, and it had debt. Okay, and I used to be an analyst that used to track Bata in the late 90s. And it was such a frustrating experience, we just let go because they were not perceived quality at any stretch of imagination. So we saw management transition. We expected, there was an Irish guy that came in there and he expected to turn around the business. He turned it around in the sense he moved the headquarters from Calcutta into Delhi. Okay, and then the quality of the balance sheet, the balance sheet started improving. But at the same time, when Bata was improving his balance sheet, you had that happen in a number of other consumer businesses. So it was not about one business or two businesses, and these were not quality stocks at that point. They were good. They weren't in secular growth companies because if you go back to levers 1997 to 2005, CAGR on growth, on top line growth was 1%. Okay. So they were cash flow generators, there was no growth, but all the cycle completely changed from 2009 to 2012, 13. And that's when the perception that these guys are secular in nature actually came through. Even consumers went through cycles, but at the bottom of the cycle, if you went to the top 2 or 3, you still made it to the, you made it when the industry came around. Of course, there were other consumer businesses that you're seeing right now, which also did very well in the likes of Umami, etc. Okay, and we participated in the trend. So we just played a cycle, an industry cycle which collapsed. But Maruti was at 12 times. Hero Motocorp now and Hero Honda at that point in time was 5% dividend. So you had polarization, and polarization gets captured at both extremes. So we did something very simple there. I don't think, and if we can keep the momentum of that on, or continue to keep doing what you did at that point in time, I'm sure you will be able to capture the next round of quality businesses, which my sense is around the corner.
You are known to be a very patient and a very long-term holder of stocks. And I'm sorry to labor this point, and it's just coincidental we're talking on a day when Bata is reporting its numbers. But as you said, when you bought, and I'm just using this as a case study, when you bought it, it was not perceived as a quality business. You know, there was a period of frustration. We started looking at the stock from an institutional broking standpoint, maybe in 2011, 2012. Years after, of course, you look at it on the sell side. And that was the time when Marcelo Villegran had just come in, and there was a bit of a turnaround that was being spoken about. So how frustrating is it that when you identify a company that can become a leader, but it tests you for time? And I actually asked this to Prashant Jain a few weeks back, when he was going through his period of underperformance. But your conviction as a CIO or a fund manager is so much. How hard is it to sit out that period of underperformance, not just from a stock price perspective, but even from the fact that the company is not performing up to its potential?
So I use it a little. I use the methodology a little different. So when we get into a particular business, and like I said, we talk about quality of business and we talk about quality of the industry cycle. Okay, so on the when the industry cycle is got shrinking profitability, and you know it's shrinking, and the industry is consolidated, you align yourself with just one company. You don't buy everything that's there. So let me put it this way: my first pick in amongst the consumer names was GlaxoSmithKline Consumer. Okay, the second one was a Page Industries, and then came in Bata post that. But till you've not seen growth levels, until you haven't seen growth levels actually reach the bottom or start doing better, you don't allocate across the cycle. So then you have to have patience with just about 3% or 4% of your portfolio not doing well. But you still have a lot of businesses that are mid-cycle, and some of them are peaking out. So the way to understand portfolios that we run or I've run historically is to bucket the entire portfolio into multiple segments of the economy, see which is where in its life cycle, and not everything is in the down cycle. Okay, some have already peaked out, some are going midway through, and some of them are just about emerging. So I like to be early. I don't like to be the last investor. I prefer to be the first investor in most of those businesses, and I'd like to be a very large investor in some of them. So that's how I like to play it. So having patience, I've had patience. The typical was, I think, Bosch. Somewhere between 2007 or 2005 to 2008, that stock didn't do anything. I remember every time you bought the stock in 4-year period, it was at the same price. Okay, but it so happened that we continued to buy it at the same price. The other one was MRF. My first transaction in MRF as a portfolio manager was in 2002 or 2003 in Kota. Okay, I held that stock right up to 2015. And there was Coromandel Fertilizers. I think in my 14 years of, my 17 years as a portfolio manager, I haven't held that stock only for 2 years. So you can call me plain lazy. I just like to, I like to be where I understand the DNA of how a business reacts to an environment. And then you know that these guys can't do anything wrong as long as you have a core philosophy in place. And you keep running with the cycles. And there are still names with me that I've held since 2007, 2008. So it's still on there.
It's easy to be lazy once you have the Bentley. It's the hard part is collecting the money to get that. So I think, it's probably very easy to sleep once you've got into those quality companies. The hard part is probably arriving at those companies. You mentioned two companies right now. Would you say that, of course, Coromandel notwithstanding, as you said, you've probably not held that stock for only a couple of years. But just looking at the scale of opportunity and the huge run-up that these stocks saw, would you say that MRF and Page have probably been two of your best investments in your career?
Oh, definitely. I mean, MRF was 100x.
Yeah.
And,
so it's not every day that you get in. I mean, it's,
Page, if I was still at IDFC, was 100x. Yes.
How did you get into these companies? I mean, what was the thought process? How did you arrive at your investment sort of thesis to get into an MRF and then see it rise 100-fold? And then, of course, the argument that I've always heard on Page for people who have not invested in it is that it is expensive at every point in time.
It was never so. It was never as expensive as it has been after a point in time. So, and both of those ideations started off fairly simplistically. So, if I trace back to MRF and the entry points in MRF, the enterprise value of that business was equal to its gross profit. Okay, that's how cheap it had got at that point in time. And it was a complete no-brainer. And you get opportunities like that probably just once or twice in a decade, or probably even once in a decade. And if you get it 2 times in a decade, the second time you don't believe it is true. And when you looked at Page Industries, he had an IPO, and And when you looked at the cash flow that the company was generating, you looked at it and wondered why the hell did he even want the today's. But it was a management that was coming out from a very weak consumer cycle, and they had some banking issues that were legacy with them, for which they didn't want to access debt, historical banking issues. And you were getting an opportunity to buy which I thought was a very aspirational brand and a fairly good franchise even at that point in time, because we had VIP and then you had Jockey, and Jockey was more aspirational than VIP was, and the metrics that were there. And it was fairly easy to do a cross check on how these guys are doing. Go to a retail store, pick up competing brands, see the date of manufacturing, and you know whose product is moving. So I think those were the basic ground checks and ground rules that we followed, and always keep your eye on the price that you're buying it at. Go back and if you want to take the quality benchmark at that point in time, category leader, no valuation, no financial stress, okay, and gaining market share at every cycle. And this is what was common between both those companies and every single consumer business that we were buying at that point.
Is it reasonable to assume that if you're buying a market leader where you are reasonably confident that market share will go up, or a virtual monopoly kind of a business or an oligopoly kind of a business, that you may relatively outperform if you are keeping a fairly concentrated portfolio, if this is the approach to investing? Is that a correct assessment to make? That you have, say, about 10 stocks in 10 industries that are all market leaders that you know will get you have a Maruti or a Page or an MRF or so on and so forth, right? And they are not a very fragmented industry. They're, is that, is over a longer period of time, do you make a lot of money if you follow that school of thought?
Yeah. So it works perfectly well as long as you got the value, you bought it at the right value. Now, why my emphasis is so much on valuation and value? Look, when you need a compounding effect on your portfolio, you need growth to kick in, which is higher than industry, and then you need the valuation multiple to expand itself. When growth kicks in, a multiple expands itself. So then you have two moving parts. So hypothetically, if you're buying a business at 50 times multiple, it's the best business in the world, monopoly, etc. You're guessing that 50 times multiple will go to 70 times, and this guy will continue to grow 15 times. But there's no science in 50 and there's no science in 80. It's expensive and it's getting exorbitant. So which is why an entry point necessarily needs to be crucial. So if you buy it at 10 times or 15 times earnings, in case of very cash flow positive business, if you're buying at 15 times earnings, then there's probably a sign that it can go to 25. Okay. After that, it goes everywhere else because growth continues to expand and money tends to polarize. Then the numerator effect kicks into play, which is the price and the liquidity, which is the P, and the E continues to do what the business cycle helps it to do. Okay. So which is why when you see me articulate or try to put an investment style, we are very focused on getting the right price. And that's that's where the success has been in the past. That's also where some of the largest errors have also been created.
Do you remember in your career where you would have bought a challenger, or somewhere where you thought a number 2 or a number 3 or even a number 5 or 6 player is doing things in the right way and will catapult itself and become a serious to the market leader? So you mentioned MRF. Did you ever look at an Apollo or a CIAT? And you briefly mentioned VIP when you were talking about the innerwear segment, comparing it to a Jockey. But there are so many other examples of stocks. Did you ever look at a Relaxo for that matter when you were looking at a Bata? So any thoughts on that in your career where you identified a serious challenger? What drew you to that company, and how did that investment eventually pan out?
No, so don't look at it. Okay, I'll take it from an investment perspective. When it makes money, then stop. Every business will grow into an expanding market. And when the market is expanding, there's space for new entrants to come in. And the bigger guy always loses market share. I am extremely cautious if the market is fragmenting and fragmenting at a pace where the smallest guy is also making a lot of money. Yeah. And that's the problem that happens is that, or that's when you say that yes, maybe there's too much of money in this industry and it'll continue to attract more capital. Okay, and it'll attract more competition. So I'm very averse to a situation where everyone makes money. And you've seen how bubble tops happen. Now, what are bubble tops and why do they happen? They happen because uh, the category leader makes a 30% ROE. Okay, new investors and new entrepreneurs come in with a hurdle rate of 15%, which is usually private equity. And then you have the banking system, which comes in at with a hurdle rate of 7-8%. And by the time the cycle comes to the top, that 30% ROE in all probabilities come down to where the cost of money in the system is.
Cost of capital.
Yes. And that's what destroys an industry, and that's where bubble tops get created. So the last 2 years have been very difficult for me to explain to investors as to we are seeing this happen in the cycle, and we are seeing this happen in this economy. So we tend to stay away from bubble tops, and we can't participate into it because the number one NBFC was making enormous amount of money, and the new guy who came in last year was making enormous amount of money, and there are 5 more registrations who are also raising capital at the same time. So that's that in short explains as to where we are in the cycle. So to answer the question, have I ever bought number 5 or number 6 in the industry? I think some of the biggest mistakes happen is when you try to go and search for value in an industry. Okay, in an industry which is doing very well, and you come across, because in every industry you will find a company at a single-digit multiple. Okay, but it's there for a reason. And yes, some of the biggest mistakes happen because you go out into a market which is highly valued and try to find cheap stocks, and those cheap stocks take you under because then you're holding solvency risk.
There are 3 questions that are coming into my mind on the basis of the answer that you just gave. Before I get into those, what percentage of the profits of an industry should be with the market leader for you to be comfortable to be investing?
Oh, in the sugar cycle, virtually 100% was with the market leader.
Ex-sugar.
Okay, if you go to fertilizers, 120% of industry profitability is with the top 2 guys. Okay, if you go to telecom, you know
okay, so let me rephrase that. At what cutoff point do you look at it? Do you say that the profits need to be at 75%, 75 or 80% of the profits of the sector need to be with the top 2 or 3 guys, and then it makes it a relatively comfortable place to be? Is that?
Yeah,
that would be a relatively fair assumption to make.
It's usually 100% with the number 1 guy. You go to the innerwear market in 2008, 100% of all profitability was residing in the organized sector, was residing with 1 guy. Of course, there's manufacturing profits that were there. Okay, if Levers was going 1% in the category of detergents, there was only 1 guy or 2 guys who were making money. Okay, P&G was bleeding itself, etc., etc. So in every established business which is large, and if it goes through the grind on the downside, you will have enormous squeeze in profitability. I'm sure if you adjust for all the NPAs that are there in the entire cycle, corporate banks do not make money at all. If you just take the corporate lending, the lending business and the corporate side, nobody is making money on it. So the down cycles are pronounced. Okay, the down cycles are pronounced when capacity gets out of the system. And this is contextual not just to India, it's across the world, because we've seen a few commodities. In 2017, we were fortunate that we had a category which was electrodes,
Hmm.
HEG and the graphite. I mean, the prices of that commodity moved up 10x in 6 months.
What did the stocks go up by? Like 100x, I think. HEG and
They didn't do 100x, but yeah, it went up from about $130 to about $5,000 or something.
you were
So
invested in more.
we caught the cycle. I mean, we were present because there was enormous amount of value that was sitting with graphite, and he had very aggressive accounting policies in terms of writing off writing off expenses, writing off all expenses, and not capitalizing anything, and also inventory costs. So we were fortunate to be there. And once you're there, you're just on top of the cycle. So you're in the top of the food chain, and we got a handle on for the prices. So it's important to follow these events, okay, and it's important to find value and you will always find value in survivors of an industry. And this was a global industry matrix, okay, and these guys came through. So yes, I'm definitely of the opinion that the survivors of the industry down cycle usually and will have a giant market share of the profitability.
Hmm.
The other context that you need and that you would that is important is the ROE metric. Okay, for us, ROE is not a number. If there's only one company making money in an industry with a 5% ROE, okay, I mean we are fine. I'd love it at that, because for us the play is low ROE to high ROE, which effectively also meant low valuation to high valuation.
Hmm.
But anything that's already a high ROE business with a high valuation, I'm on public record to say that I don't know how to predict growth. Growth is the next. It's an extrapolation of an Excel sheet. So you catch and drag it, and you get growth, and that's been my historical experience in trying to predict growth. So for us, it's fairly critical as how do you squeeze a cycle in, getting at the bottom cycle. In the third, fourth, fifth year, I think you've got multiple industries at a very different evolution chain in your portfolio. And then the clock starts ticking in terms of returns.
There is a company which is cash rich, which is an industry leader from where the bulk of its profits come. But it's very cheap compared to the rest of the sector because there is a regulatory overhang, which is ITC. Now, I have this conversation and I've been having it extensively off late with a lot of fund managers and CIOs as to why the discount on ITC is so large. I mean, it is trading at half the valuations of anything else in the consumer sector. I'm not even getting to where Hindustan Lever and Nestle and Britannia are trading. I mean, anything else in the consumer sector, you can't find anything less than 30p today. This guy is trading at about 15, 16, 17 times. What is so wrong with the ITC model, and why is it not something with 25, 30,000 crores of cash on books? It's a tobacco play. It is pretty much controlling the profits of its industry. The management quality is good. The return ratios are in the mid 20s. Why doesn't it sort of find its mark on the podium, so to speak?
I think there's more to do with it. There's the cash flow and the valuation of that entire business. It gets a fair valuation in line with what markets are valuing it at. I also have to look at the numerator that actually drives it. I mean, the liquidity that is driving most of these companies. And you've got a predominance of now funds which are more ESG relevant. Okay. And you will see that happening even with liquor companies as it goes forward. You've seen that happen in coal, you've seen that happen in tobacco, you'll also see that happen with liquor company as it goes forward. So I won't write off the cash flows, but over a period of time to get the valuation back, the business has to restructure itself around something more sustainable and compliant. Okay, and compliant. So maybe that's an answer to it all. But if you have to simply buy cash flows and dividend yields, Coal India is also good, and ITC is also good.
Are you more mathematically driven when you approach your investments, or are you a kind of person who'd roll his sleeves up and go meet the management, spend a day at the plant, try and have a cup of tea with pretty much everyone you can meet to get a handle of how the company is working? I mean, there are different kinds of investors out there. What works better for you? Because you run even at Oldbridge right now, if I'm not mistaken, your long-term equity and a couple of your other funds are fairly concentrated portfolios, about 15,
That's
20 stocks. And I think your AUM is close to about $500 million or thereabouts. So you do take a fairly concentrated bet. So is an Excel sheet just enough where it shows up on a screener and you make your projections, or do you need, are you more an on the ground and a hands-on kind of a person? Let's go to the plant, let's talk to the workers.
I used to travel quite a bit, so it's needless to say I like meeting people, getting validation of what seems to be numbers in terms of the brick and mortar that exists underneath all those numbers. So it's just a validation of what is already prevalent. I mean, we've been investing in agriculture for a long period of time. It's only when you go down to a seed company and visit its lab that its labs are in the field and not lab as in laboratory that we most commonly picture, right? So it's 1,000 acres, and so those are the nuances of what we learn. So we've been very fortunate in this trade that you know a lot about a lot of things. Okay, and it's nice to meet so many people across various industries. But this is more validatory in nature rather than being a decision maker.
You once said, and I hope I'm quoting you correctly, that if over-regulation gets the better of a sector and the sector comes down on its knees, something is about to change. Things will get relaxed.
They do, they do.
Where
And
is an opportunity if I was to extrapolate that in today's India? We're going through Corona times. We don't know how we're going to come back on the other side. Is there anything, uh, that is over-regulated where you think things might get relaxed? And, we've seen a little bit of incentive schemes that are given out by the government, these PLI schemes for mobile phones and things like that. And, one of those companies is up about 5 or 6x in a year. They're probably going to extend it to pharmaceuticals, and we've seen what's happened to that space. But any place where you think regulation was a bit of an overhang and it's presenting a phenomenal opportunity right now?
no, not really. I mean, when I made that statement and talked about over-regulation of a particular business, when you over-regulate a particular business, you just do not invite private sector participation into that business at all. And all of that happens in the social sector right now. I think healthcare, from a business opportunity wise, it's superbly over-regulated. There is no free market pricing of that product on the ground at all. Okay. If you allow for free pricing of that entire product, you're democratizing the sector. So market will take care of the pricing by itself. If you didn't have 15 participants in telecom, you wouldn't have telecom rates which are the cheapest in the world. So when I say over-regulation, do not control capacity. Allow capacity to come in, rates will fall by themselves because everyone needs the reason to be in existence. And you need foreign capital, or you need capital essentially to build business and enterprises on the ground. So over-regulation, I mean, when I say over-regulation, that essentially is over-regulation. Over-regulation can't choke profitability. There are a couple of sectors, but I don't think India is this place where there are so many people, so many places where things are over-regulated. You'll find it in fertilizers a little bit. You obviously find it in the social sector across the board. I mean, government services is one of them, and like I say, healthcare on the ground is another one of them. But the rest of the industry seems to be pretty much okay. I mean, most of the commodity companies have gotten over that, while there are regulatory but it does suffocate profitability at this end.
Any companies that have caught your eye that are in the process of a significant transformation that are looking interesting from a new India perspective? I mean, let's look at Reliance, for example. I mean, what has happened during the lockdown has been quite phenomenal. The way it's raised the money and trying to become a consumer tech company and retail, and it's probably more than halfway there. Something similar could be said about ITC, for example, if they put that 25,000 crores to use and try and reduce the dependence on tobacco and sort of re-emerge. I mean, these are two cases in point, but anything that you're seeing out there that's fairly transformational and in nature, given that we've had one live example which is so current and is staring us in the face.
I think I look at something a little more secular than that, and it's not just about a company or two that will benefit.
That's not to say Reliance will not be secular. I mean, the way it's changing, it's never going to go back to being a pure oil and gas play now. It's what it's done. It's fairly secular now for the next 20, 30 years.
Yeah, fair enough. I mean, I'm not going there. I'm not saying anything about this. One or two companies out there. I mean, if you find secularity from an India context and an India story, see, you pick up a profit and loss account of any business, or you pick up an income statement of any business, right? For every 100 rupees that you sell, for every 100 rupees of sales that companies generate, apart from raw materials or commodity prices, there are three large areas of expenses. One is financial cost, okay, which is interest. Second is employee expenses, okay, or wages, and the third one is electricity cost. Okay, in all of these three, and let's put it one, wage inflation is not coming back. Okay, it's not going to come back next year. It's not going to come back the year after that, and probably you'll see a decade of very low, extremely low wage inflation. If not, you'll see no wage inflation as the systems get automated more and more. If you see the decadal change in interest rates where India was, I mean, the mid 90s was about, the average was about 15%. Last decade it was about 10%. This time it was about 7 and 8%, and the next decade is going to be even lower. So financial costs have gone off. And the third most critical part, and that's 10% of the P&L account, is electricity and power and fuel. That is falling off the cliff. Okay, if there's one industry which is seeing massive changes, is the way industry will have access to power in the next decade. If you take these three line items, which account for close to about 20% to 25% of total spends, okay, and 55% is raw materials. Raw materials got their own cycle, so it's fairly predictable for track commodities. But these three are fixed cost elements to drive X amount of capacity. And if each of these go down, or go down by at least 20-30% over the next decade, okay, that's the opportunity that India has on the when we enter into the next cycle.
Right.
So yes, everyone's going to benefit. The guys who are smarter and who can scale up significantly more will be right ahead of the entire growth and everybody else. And I'm fairly excited to be at both ends. I mean, guys who benefit from it and the guys who are driving those costs down. I like to be at both ends of the spectrum to see where the value is going to be created for me as a shareholder.
Interesting. Let me take you back to where you started your career and writing the
Yeah.
And, to that extent, I think your and my careers are aligned. I had a past in media too, in some ways. How do you go about analyzing IPOs? And apart from Page Industries, I mean, are there any IPOs that you invested in that became really successful? And sort of what is your thought process about companies that are going public? What all do you evaluate? Because there's a very big leap of faith that you have to take on the management also, I assume, as opposed to a listed company where you have, the numbers are in public domain for a certain amount of time. So since you started writing the journal, and if I'm not mistaken, somewhere it was written that the eventual subscriptions were very similar to your thought processes. So you were pretty good at analyzing these IPOs. So tell me a little bit about that.
There's a fair amount of data that's already available about companies that are going public. I mean, today,
then, when you
even at that point in time, there was a fair amount of information. So as a journalist, life was a little difficult because phones were not very easily accessible. Most of the internet was not there. This was in the early 90s. And most of the communication used to take place on fax machines and telex machines. The new generation don't know what it looks like, but that was where most of the most of the communication usually took place. And you have to book a STD call. It used to come back to you after 2 hours, and people used to get connected on that. But people are much more open, talking about competitive intensity of those businesses, whether the promoters were around, not around, and you had to shift through enough of journals. So I was fortunate to be in a place where the database was robust. I mean, it was extremely robust, and you could look up. And if you had the mind for it, and if you had data, and there were people out there who could remember which magazine, what page, which company was covered, and which company made what. I mean, we didn't need to go through databases. I mean, a lot of us out in that publication knew which company made what and where. The other significant thing about that era was we are a closed economy, so you didn't have to worry about imports and global commodity prices, etc., etc. Just look at the dynamics of India, and you would be able to figure out things out there. In competitive intensity, not very much. In steel, you had two manufacturers, maybe the third manufacturer existed. The same thing with automotives. So it was a very small market at that point in time. And you had very small companies coming out into the IPO stage. And a lot of them were mom and pop shops who wanted to collect money and grow a little bit incrementally. But then it all came down to one last number is the ambition of the business and the scale of the business. So if you got your statistics right at that point in time on the scale and get the entrepreneur's vision proper, I think largely you would be able to achieve that. Nothing much has changed except that the amount of information that you get downloaded on you today is significantly more than you want to analyze. But apart from that, it all remains status quo. The international market, commodity prices, don't worry about it. There's enough of material written on what's happening there. There's enough of competition analysis available of every single business that is there. It's just the journey of the entrepreneur, where he started from, what are the years to take a certain business to a certain number, and your ability to predict that whether he still has it in him to take the business into the next 5 or 10x from where it is over the next decade. And that's a leap of faith that you have to take. Okay. It definitely helps. It definitely helps if he's number one in this category. And if it definitely helps if the category is extremely tiny. Okay. So there are a number of patterns, and each business is very different. I mean, you had a India Mart that did a fabulous issue at this point in time. I mean, Page Industries was the last decade. Then there was a Kaveri Seeds that happened out there. And a number of such, and there was another one that we did when I was in India, Astral, at the IPO. 300 crores of market capitalization was the surface number. So there are a number of that did happen. Again, tiny businesses that suddenly scaled and became large. And these were probably the only guys operating in that industries, and they had a massive footprint. I mean, IEX was the other one that IPO'd about 2 years back.
Interesting. You are obviously the poster boy for Nitin Gadkari, that you had 2 electric vehicles for the longest time, and you've done 45,000 kilometers on them. And conversely, you are somebody who likes to have a new phone every time it comes out. Is that correct?
No. Phone. My phone's 4 years old. I don't like a new phone. So my phone.
So how come you haven't graduated to a Tesla or something like
that? I mean, I like my old cars. They're nice, they're convenient, and they're very small. So that you can squeeze through everything. I've got a thing for small cars. And Reva is 2008 manufactured, 2007 manufactured, yes. And it's still running. It's in okay condition.
What do you make of Elon Musk and Tesla? Since you are a proponent of electrical vehicles and he's a bit of a maverick himself, I'm sure you've done a lot of reading and...
No, the electric cars fascinate me. I mean, the simple way I like to put that together is you carry a power with you. You don't carry a power plant with you in a normal diesel, in a normal IC engine. When you
Mm-hmm.
drive a car with an engine in it, you're carrying a power plant. In this thing, you're just carrying the raw material, which is electricity, and that's a fascinating change in how it works. And when you're carrying it, it's obviously more efficient because at the back end you're generating power at an industrial scale, which makes it more cheaper, which makes it greener, and you can run it at this. So that's the way the transition of the electric car is. And if you've seen the science behind how that's actually taken up, it takes up 50% of the weight of the car.
Mm.
Okay. And it's zippy. It probably doesn't. The first generation of cars are not as don't have that mileage to it. But apart from that, they meet every single purpose that they were made for. They are people carriers. They are transportation vehicles. And that's what fascinates me about that one car, which is why I bought the second one also. And yeah, that's the way it is. What fascinates me about Elon Musk, I mean, he's like a maverick by himself. Yes, like you said it. It's very interesting to listen to his interviews and conversations.
Yeah.
He never fails to surprise.
Mm.
And he always surprises you. He always surprises you. So what do I think of him? I hope he's around for a very long time doing stuff that he's very good at. And it's fascinating how he's taken legacy business models where the governments have been a dominated part of that entire industry and just broken it up.
Mm.
Okay. Automotive, space, and transportation, public transportation.
In many ways, he's the antithesis of you.
I wouldn't want to be.
You're calm.
I mean, you can't say the two names in the same breath. It's not fair.
Therefore, that contrarian sort of works its way into that. So obviously, you're in the world of investing. Warren Buffett is considered to be the father in many ways. There's so much written about him. You like technology, disruption, electronic vehicles. We've spoken about Elon Musk, and I believe you're into Western music as well. You like to listen to it with your daughters. I don't know if you play anything, but if you had a chance to spend an evening with Bono or Paul McCartney or Elon Musk or Warren Buffett, who would you choose? Would it be more music? Would it be more Elon Muskish, or would it be a somber evening over a McDonald's burger and Coke with Warren Buffett?
I like to know the future. So obviously, with someone who can actually tell me the future.
Wouldn't we all love that?
Mm.
Wouldn't we all love that?
So obviously, I like to know what's happening. I fancy looking at trends and how they move and how they shift. So amongst everyone out there, I think the tech guys and Elon Musk is probably the. I'd be all ears, and I can't contribute to any conversation he makes.
Well, I hope I have the opportunity to meet him someday. He's someone I admire, and I read up a lot about him as well. But I could probably say Professor Andrade here because I've learned so much from you today. I'm sure all the people who've logged into this broadcast have got an insight, a little bit of an insight into how you think and how you approach investing. It's been a bit of a teach-in, so to speak. I think we've done a few case studies along the way. But it's been fascinating listening to you. And I really want to thank you for your time and for sharing your wisdom. And I hope you enjoyed being on.
Wonderful conversation, Rahul. Thank you.
Pleasure. Please do stay safe. And hopefully I will see you in person once lockdown completely lifts in the not too distant future.
We will do that for sure. Thank you very
much. Thank you so much, Kenneth. Much appreciated. Thanks a lot. Take care.
Have a lovely weekend.
You too. And thank you to everyone who's joined into this broadcast as well. Thank you so much.